Hello dear students, myself CA Nikunj Amlani, faculty at Navkar Digital Institute and Navkar Institute. We are going to start today the federal taxation of entities in regulation subject in US CPA course. That the US CPA course, the regulation subject covers this taxation part, and in that there are total three parts covered: property transactions, individual taxation, and there is entity taxation. We just refer it into short. In this federal taxation of entities, there are total 23 chapters which we are going to learn one by one. So all the concepts will be covered here. In the entities, if we consider, there will be a corporation, there will be partnership firm, there will be trust, there will be estate. So there are different entities being covered here. And for each and every entity, we'll see the rules here. So we can just move further. Okay. Now, total 23 chapter, as I told you, the first chapter we are going to start, that is formation of corporation. Chapter number 1, formation of corporation. Let's see. Okay. Now, gain or loss on a contribution of a property by a member in the exchange of a stock recognized on the basis of ownership level of a contributing shareholder. See what they are saying. A person is a contributing property to a corporation, and corporation is a issuing stock. We are contributing property, and the corporation is issuing as a stock of the corporation. Then what will happen? In that case, gain or loss will be recognized on the basis of ownership level. What is your ownership level? Accordingly, it will be decided whether you have to recognize gain or you have to postpone the gain. So it depends upon the ownership level. Be very clear. Okay. Deferral of gain or loss. What is the meaning of deferral? Deferral means you are postponing the gain or loss. You are not recognizing right now, but it will be recognized in future. So it is called the deferral. It is called the postponement. Gain or loss on the transfer of property in exchange of a stock is deferred by a member of control club. Look at the word, member of control club. If you are a member of control club, then the gain or loss on the transfer of property in exchange of stock will be postponed, will be deferred. So you need to consider that. Member of control club includes an individual or a group of individuals who transfer the property in exchange of a stock and are in control of more than 80% of the voting and non-voting stock. Look at the word. Individual or a group of individuals who transfer a property and they receive a stock in exchange. Stock in exchange of property, and they should be holding more than 80%, more than equal to 80% of voting and non-voting stock after the transfer. Then they are considered as a member of control club. Stock includes equity as well as preference, but not a non-qualified preferred stock. That is a preference redeemable within 20 years. And now here we use the word stock. That I am giving a property and I am receiving a stock in exchange. What do you mean by stock? Stock means it can be equity stock, it can be preference stock, but it do not include the non-qualified preference stock. What is a non-qualified preference stock? Non-qualified preference stock means a preference stock which is redeemable within a period of 20 years. There must be a transfer of property and not a services in exchange of stock. Shareholder will transfer a property and receive a stock. Then the gain can be postponed, loss can be postponed. If you provide a service in exchange of stock, then the postponement rule is not applicable. Be very clear. It should be property in exchange of stock. Transfer of property by an existing shareholder qualify for a MOCC test if it is more than equal to 10% of value of stock owned by him. Okay, what they want to say, transfer of property by an existing shareholder will qualify. Okay, let's say person, Mr. X, is holding already a stock worth 20,000. He transferred a property worth 3,000 and received stock of, let us say, 10%. 10% stock he has received by transfer of property worth 3,000. He is already holding a stock worth 20,000. He transferred a property worth 3,000 and received 10% of the stock. So whether this 10% of the stock should be included in MOCC test means whether 80% test will include this 10% of the stock. Answer is yes, because 3,000 of property transfer, which is more than 10% of this existing holding. So 20,000 is your existing holding. If you make a 10%, it is coming to 2,000. The property value is more than 2,000. That's why this 10% of stock will be included in MOCC test. So just be very clear on it. Providing service in exchange of stock also qualify for MOCC test if the transfer a small amount of property that is more than 10% of value of service. Look at this. Mr. X transferred to a corporation property worth 2,000 and provided services worth let us say 15,000. 15,000 worth of services and 2,000 worth of property and received 20% of stock in exchange. So whether this 20% will be considered as a MOCC, now see, we do not consider services as you know, but you also transport a property. Property value is 2,000. Is it more than 10% of the value of service? Yes, it is. Service value is 15,000 and property value is 2,000, which is more than 10% of the service value. That's why this 20% will be considered for MOCC test. So just be very clear on it. Normally, only when you transfer a property for the stock, it is considered as MOCC test. But here we are transferring, providing services for the stock. In that, if I transfer property also along with service, then that can be included in the MOCC test if the value of property is more than 10% of value of services. So these are certain exceptions to be considered for the purpose of MOCC. So simply, member of control club, MOCC means the person or group of persons who hold more than equal to 80% of the stock after this transfer happens. Gain to be recognized by member of control club will be lower of gain realized or boot received. This formula we have seen very previously, if you remember the property transaction chapter, wherein we have seen the gain to be recognized, that is realized gain or realized gain or boot received, whichever is lower. What do you mean by boot here? Boot means anything received other than stock. If you are receiving anything other than stock, it is considered as a boot. Depreciation, recapture, transfer to the corporation. It will be transferred to the corporation. It will not be recognized by individual. Just be very clear. Normally, whenever you transfer a property, you recognize gain equal to depreciation. But here, it will be transferred to corporation. It will not be recognized by individual. So these are exceptions given. Okay, friends. So member of control club has to recognize a gain up to the realized gain or boot received, whichever is lower. Stock in exchange of service. If you are providing a service and you are receiving a stock in exchange, then what will happen? Transferor has a wage income is equal to FMV of the stock and it becomes a basis of the stock, and the corporation has a salary expense deduction. Okay, fine. Let's say Mr. A is there who provided a service to a corporation worth 10,000 and he received a stock in exchange. Mr. A provided a services worth 10,000 to a corporation and he received a stock in exchange. Now what will happen? This is going to be taxable as a wages to Mr. A. This 10,000 is going to be taxable as a wages to A and corporation will get a deduction also. Fine. Okay, now this 10,000 as taxable as a wages to Mr. A, he will get a basis of 10,000 for the stock. Whatever stock he has received, that 10,000 will be basis for the stock. So whenever he sells the stock, this 10,000 will be used as a basis for gain calculation. So just be very clear, when you provide a service and you receive a stock in exchange, that will be taxable as a wages to you and it will create a basis for the stock received. Okay, adjusted basis of the property. Adjusted basis of the property, what will be the adjusted basis? Adjusted basis taken as a carryover basis. Just one word is enough. Carryover basis means whatever adjusted basis was there, it will be carried over. It will be continued for the receiver. The transferor's basis will continue to the receiver. That is called carryover basis. Now different, let's see. Adjusted basis of shares for the shareholder. Shareholder is receiving a shares in exchange of a property. So it will be basis for him. Let's see, that is adjusted base of property transferred plus gain recognized less boot received less liability assumed by corporation. That is a formula. Or in a second sense, we can say FMV of the property transfer less gain deferred plus loss deferred. See, look at the formula. This is the adjusted base of stock for the shareholder, they want to say. Adjusted base of stock will be FMV of the property transferred less gain deferred, means gain postponed, or you can say plus loss postponed. This is a small formula you can apply for that, or this is a long formula. You can apply any one of them, you will get the same answer. There is no problem at all. But this is adjusted base of shares for the shareholder. Now adjusted base of property for a corporation. What will be AB of property for the corporation? It will be adjusted base of property in the hands of shareholder plus gain recognized by the shareholder. Look at the formula. Adjusted base of property for the shareholder plus gain recognized by the shareholder. Okay. Now adjusted base of the lost property, that is adjusted base is more than FMV. If adjusted basis of lost property we are talking for, where AB is more than FMV, what is the default rule? Default rule is that adjusted base of property for the corporation will be net loss is adjusted against the adjusted basis of the lost property proportionately. See, this loss will be adjusted to the corporation, means adjusted basis less the losses. So it will reduce to FMV in the simple sense we can say, and adjusted basis of stock for the shareholder will be adjusted basis of the property transferred. So either of one will bear the loss. Here the corporation is bearing the loss on this and a shareholder is getting AB straight away. But there is a exception also. If a shareholder and the corporation both elect, then adjusted basis of property for a corporation will be AB of the property transferred and AB of the stock for the shareholder will be AB of property less losses. How it will be? Let me tell you. Mr. X transferred a property to a corporation whose AB is 10,000 and its FMV is, let us say, 8,000, and he received a stock in exchange. Now what will happen? For X, we need a basis of the stock, and for corporation, we need a basis of the property. Now, if I talk about a general rule, then AB of stock for X is going to be AB of the property, that is 10,000, and AB of property for a corporation will be 8,000. That is a general rule. But there is an exception also. Exception is that if both of them agree, corporation and X, both of them agree, then it can be a reverse rule. Adjusted basis of stock for the X will be 8,000 and adjusted basis of property for a corporation can be 10,000. So the loss can be borne by either of one, either a corporation or a taxpayer or individual, fine, a shareholder. Depends upon their election. General rule is that the loss is to be borne by a corporation, but they can have an exception. They can decide that the loss can be borne by a shareholder also. So the exception to be applicable depends on the situation. You need to see whether exception has been applied or not, and accordingly it will be seen. So in general, corporation will bear, but as per the exception, they can decide that shareholder can also bear the loss and AB will be reduced. So either of one will reduce the AB. Okay, now adjusted base of the property when debt is assumed by a corporation. When debt is assumed by the corporation, see, we are transferring a property to a corporation and on that the debt is outstanding and that debt is being assumed by the corporation, then what will happen? If debt assumed is more than adjusted base of the property, then gain to be recognized immediately is equal to debt assumed less AB of the property, and shareholders AB of the stock will be 0. Look at the word. If debt assumed is more than AB of the property, means let's say adjusted basis is 5,000 and debt assumed is 6,000, then debt assumed is more than AB, then the difference 1,000 is to be gained recognized immediately. That is a requirement, and the shareholders basis of the stock will be 0 now. You just consider that. And now if debt assumed is not for a valid business reason, look at that, not for a valid business reason, means the debt outstanding is there but it's for the personal purpose, not for the business purpose, then what? Full debt is considered as a boot received, so gain to be recognized is a full debt or gain realized, whichever is lower. If it is for a non-business purpose, then you need to recognize full debt assumed as a gain recognized. Look at this word. Or the simple formula, it is actually boot received. The boot or gain realized, whichever is lower, you need to recognize the gain. But in the above situation where you see it was a business debt, then it is to be recognized only difference. That's debt minus AB. But here full debt is to be recognized as a gain. Shareholders AB of the stock is equal to adjusted base of the property plus gain recognized less boot received. That is debt assumed. It's the same formula what we have seen previously. So that you need to consider for adjusted base calculation. Example is given here. X transferred a property with FMV 100 adjusted base 60 to a corporation having a mortgage of 70. Here a gain of 10. How it is? Because see, mortgage is 70 and AB is 60. So debt assumed is more than AB. So difference of 10 is going to be recognized immediately by X, and adjusted base of stock will be 0. That's a very first situation. Second, Mr. X transferred a property with the FMV 100 and AB 60 to a corporation having a mortgage of 50, which is not for a valid business reason. Here a debt of 50 is considered as a boot received and gain realized is equal to 40. How it is? FMV less AB, that is 40. So gain will be recognized equal to 40, that is boot received or gain, whichever is lower. So boot received was 50 and gain is 40, whichever is lower. So 40 you need to recognize. And adjusted base of stock will be 60 adjusted basis plus gain recognized 40 less boot received 50. So it is going to be 50. That is your adjusted base of the property. So this way you need to see the calculation for adjusted basis. In the different situations, the debt assumed and everything, you need to see very carefully how much is the debt assumed and how to recognize it. So just see the rule very carefully. Now let us see the rule about holding period. Holding period of property for a corporation includes the holding period of property by the transferor. So shareholder has transferred a property to the corporation and received a stock in exchange. Now for the corporation, the holding period of property will include the holding period of transferor. It means the shareholder's holding period will be included in the holding period of corporation. Let's say shareholder holded the property for 1 year and then he transferred to the corporation. So corporation will have a holding period 1 year plus whatever holding period corporation is having. So that is going to be added. Holding period of stock by a shareholder. Now whatever stock he has received in exchange, for that what is the rule? If received in exchange of section 1231 asset or capital asset, then it includes the holding period of property transferred. But if it is received in exchange of ordinary asset, then begins from the date of receipt of the stock, that is all period is not included. So you need to consider against which asset you are receiving the stock. If you have given section 1231 asset or a capital asset, then the holding period of that asset will be included in the holding period of stock. But if you are receiving the stock in exchange of ordinary asset, then the holding period of it will not be included in the holding period of stock. So just be very clear on it. Next, debt versus equity. If a contribution by a shareholder to a corporation is assumed to be debt, then distribution from the corporation to the shareholder will be income to the shareholder and deduction to the corporation up to interest element. And if it is considered as an equity, then distribution is an income to the shareholder as a dividend income, but no deduction to a corporation. Look at this. Sorry. What they are saying, a corporation. So friends, if that a contribution is considered as a debt, then on the debt, whenever a corporation is distributing something to the shareholder, then it will be considered as an interest income to the shareholder, contributor, and expense to the corporation. But if that contribution is considered as an equity, then the distribution will be considered as a dividend income to the shareholder, but it will not be deductible to the corporation. So just be very clear on it. What it is stated, that is more important. Now we are talking about capital contribution. Capital contribution means a receipt of money or the property by a corporation without giving anything in return. If nothing is given in return and just a property has been contributed, that is called as a capital contribution. Like normal way, if you are giving a capital to the business, you are not getting anything in return. It just creates your base. Capital base is created. Property contribution by the shareholder. No gain or loss to a corporation. Shareholders AB of the stock is increased by the adjusted base of property contributed. So whatever stock you are holding already, the basis will be increased by the property contribution by you as a capital contribution. Corporation is not going to recognize any gain or loss, but shareholder will increase the basis of the stock, whatever he is holding, by the value of property he has contributed. Property contributed by a non-shareholder. If you are not a shareholder, then what? And you are contributing property as a capital, then what? Corporation recognizes a gain equal to FMV of the property received, and adjusted base of property for corporation will be FMV of the property. So you have to recognize, corporation has to recognize a gain on that property, and the basis of the property will be equal to FMV. Money contribution. If you are contributing money as a capital, then what? Reduce the basis of the property purchased within a 12 months from such money contribution, and balance money left will reduce the basis of other assets. See, if a shareholder has contributed money to the corporation, then what will happen? Whatever property has been purchased by the corporation within a period of 12 months from such money, it will reduce the base of that, and the remaining unused money will reduce the basis of other assets. Okay, like let's say a shareholder contributed to a corporation 50,000 worth of cash, 50,000 worth of cash as a capital. Now corporation purchased the property is worth 35,000 within a period of 12 months. Then this 35,000 of the adjusted basis will become 0, as this 50,000 will reduce the basis. So out of 50,000, 35,000 property has been purchased, so its basis will be 0, and remaining 15,000 of the money which has been unused, it will be used to reduce the AB of other assets. Whatever other assets the corporation is owning, basis of other assets will be reduced by this remaining 15,000 of cash, what is being unused. So you need to consider this for capital contribution. Okay friends, so this being a theory for chapter number 1. Now friends, let us see the MCQs for unit number 1, gross income, general concepts, and interest income. Okay, question number 1. To be a member of control club, the individual or a group of individuals must hold at least a dash percentage of the stock in exchange of property. If you want to be a member of control club, then how much percentage of the stock should be owned by you after transfer of property? It should be 80%. The answer is C option, 80%. X transferred a property to A corporation in exchange of 20% of the stock. Y also provided services to A corporation in exchange of 10% of the stock. Who are eligible to be included in MOCC, member of control club? A has transferred a property and received a stock. B has provided services and received a stock. Who will be eligible? Simple. A will be eligible because receipt of stock in exchange of only service will not qualify as MOCC. So only A, who has transferred a property in exchange of stock, will qualify. Answer is B, only A. Next, P and Q provided a services worth 10,000 and 20,000 to X corporation and also transferred a properties worth 800 and 2,500 respectively in exchange of a stock of X corporation. Who will be eligible to be MOCC? Okay, fine. See, both have provided services as well as transferred a property and received a stock in exchange. Now, remember the rule, the value of property must be at least 10% of the value of service. Then he can be considered as MOCC. Okay, fine. If you check for P, then it is 10,000 of the services and 800 of the value of property. It is less than 10%, so P will not qualify. And for Q, if we talk about 20,000 worth of service and 2,500 worth of property, it is more than 10%, so Q will qualify. So who will be eligible to be a member of control club? Answer is Q only. What if in question 3 above Q had provided properties worth 1,500 only? If we talk about Q and the property value is 1,500 only, then it will be less than 10%. So 20,000 is the worth of services and 1,500 property is less than 10%. So he will also not qualify. So Q will also be removed. That's why none of them will qualify as a MOCC. How much of gain is to be recognized by a member of control club? How much of gain is to be recognized? Remember the rule, gain realized or both received, whichever is lower. The answer is C option, lower of the above. Gain realized or both received. For the receipt of stock in exchange of the services, receipt of stock in exchange of service. If you provide a service and you receive a stock in exchange, then what is the treatment? Treatment is that it will be taxable as a wage income to the recipient and deductible as a salary expense to the corporation. It is both of the above. Both treatment will be given. The recipient, stock receiver will be taxed as a wages and the corporation will get a deduction for the wage or salary. Both of above are correct answer. X provided a services worth 1,000 to A corporation in exchange of 20% of the stock of A corporation, which amounts to 1,200. What is a tax consequence to X? Okay, fine. He has provided a services worth 1,000 and received a stock worth 1,200. We need to check the value of the stock. There is a 1,200. So that will be treated as a wage income to the person who has provided service, as well as it will become basis of the stock. So you can see B option, wage income 1,200 and basis of stock 1,200. So whatever value of the stock you have received, that will be wage income as well as it will be basis of the stock for X, means the service provider. A transferred his car whose AB is 5,000 and FMV is 8,000 to X corporation in exchange of a 20% equity stock, and also he received a cash 500 from the corporation. How much of the gain is to be recognized by A? Look at this. He provided a property, received a stock as well as received a cash. Now whatever stock is receiving, that is non-taxable, means the gain can be postponed, but the cash received is considered as a boot received and the boot received part will gain to be recognized. Okay, how much is gain to be recognized? First we need to see the boot. The boot has been received, that is cash received is 500 and other is a gain realized. How much is the gain realized? You can simply say FMV 8,000 and plus cash 5,000, so it is equal to 8,500 less AB 5,000, so it is equal to 3,500. 3,500 is a gain realized. Whichever is lower, the answer is 5,000. 5,000 of gain is going to be recognized. So answer is A. Okay, in question 8 above, what will be AB of the stock for A? Adjusted base of the stock for A. Friends, adjusted basis, what is the formula? Formula is very simple. FMV less gain deferred. FMV less gain deferred. That's a formula. Total gain is 3,500, out of which you are recognizing 500 only. So 3,000 of gain has been deferred. So what will be your adjusted basis? 8,000 minus 3,000 is equal to 5,000. The 5,000 will be adjusted basis of stock for Mr. A. Answer is A, 5,000. In question 8 above, what will be adjusted base of property for X corporation? If we talk about adjusted base of property for X corporation, the formula is adjusted basis of the property received plus gain recognized by the shareholder. Okay, gain recognized is how much? 500, and AB of the property received is how much? 5,000. So 5,000 plus 500 is equal to 5,500. So B is the correct option. Next, P transferred a property to A corporation whose AB is 5,000 and FMV is 3,000 in exchange of 10% of the stock. What will be AB of a stock for P and AB of property for A corporation? Now see, here it is a lost property. If you just check it out, the FMV is 3,000 and AB is 5,000. There is a loss of 2,000. Now remember the rule, who will bear the loss? If you talk about a general rule, then the loss is to be borne by corporation and the shareholder will recognize AB itself. So AB of property for the corporation will be FMV, that is, it is reduced to FMV, and AB of stock for the shareholder will be AB itself. So they are asking AB of stock for P and AB of corporation. So for P it will be AB itself, that is 5,000, and for corporation it will be FMV, that is 3,000. So 5,000 and 3,000 is the correct option. C is the answer. X transferred his property whose AB and FMV is 1,000 to A corporation in exchange of a stock. There was a debt outstanding on a property of 1,200 which was assumed by A corporation. What should be gain recognized by X and what will be adjusted base of stock for X? Okay, now we just see about AB is 1,000 and debt assumed is 1,200. That is more than adjusted basis. If debt is more than adjusted basis, the difference is to be recognized as a gain immediately. So difference will be 200. 200 of the gain will be recognized immediately, and AB of the stock for the shareholder is considered as a 0. So answer is 200 and 0. Option D. Next, A received a stock in exchange of a transfer of property to a X corporation. The property was a capital asset for A and was held since 5 years. A sold the entire stock after 3 months. How much will be the holding period of the stock? See, you are receiving the stock in exchange of a capital asset. You remember that all the holding period is going to be included in the holding period of the stock as you are receiving it in exchange of capital asset. So it will be included. That's why answer will be 5 years old and 3 months now. So 5 years plus 3 months. C is the correct option. X was holding a stock of A corporation worth 1,000. He contributed a property to A corporation whose AB is 500 and FMV is 700 without receiving anything in return. What is the tax consequence to X for a contribution of property? Okay. Now, as you know the rule, when a shareholder is contributing a property to a corporation as a capital contribution, then gain is not to be recognized, but his existing basis will be increased. The existing basis of the shareholder is 1,000 and he has contributed a property whose AB is 500, so it will be increased to the basis of existing shares. So 1,000 plus 500, the existing basis will be 1,500 now. The C is a correct option. No gain to be recognized, but new AB will be 1,500. Next. M Corporation received a money contribution of 5,000 from a shareholder A. M Corporation brought assets worth 6,000 from such money within a 12-month. What will be the adjusted base of the property? See, the money contribution received is 5,000, but the assets purchased worth 6,000. So total 5,000 has been used for it and additional 1,000 has also been used. So what will happen? That 6,000 cost of asset less 5,000 contribution will be reduced. So 1,000 is going to be AB of the remaining property. So answer is 1,000. 6,000 of the asset purchase and 5,000 money contribution, so that will reduce. Final answer is 1,000. So that's the correct answer to be checked. So friends, this being the MCQ for unit number 1 in entity taxation. Now friends, let us discuss the next chapter number 2, corporate income. Okay, corporate income is a chapter we are going to discuss. In that we will discuss that how the corporate income is calculated and what are the additions and deductions into it. Let us see. It's a very simple format. First of all, realized income is to be written here. Then we will exclude it, deferred and excluded income. First of all, we are writing all the incomes in that, and then we reduce deferred or excluded income from that. So we will get a gross income. From gross income, there are two deductions. One is the COGS, that is cost of goods sold. Another is a special deduction. Certain special deductions we'll discuss in the chapter, and we'll get to come to know what all the special deductions are there. And finally, we'll get a taxable income. Then the tax rate will be multiplied, so we get a gross tax. Then the credits and advance tax, CDS, will be reduced, plus any other tax will be added, so we get a net tax payable or refundable. So it's a very simple format, nothing complex in that. Simply you need to just take the incomes, exclude the exempted or deferred income, and then the gross income. Out of that you reduce the two things, COGS and special deductions.
You will get taxable income, multiply the tax rate, you will get a gross tax, and remove from that the tax credits and advance tax and TDS and everything, you will get a final tax liability that is payable or it is refundable, whatever the case may be. Okay, let's see some general rules for income purposes or taxability purpose for the corporation. Generally, all the ordinary business expenses are deductible. All business expenses will be deductible relating to business ordinary expenses. Also, some special corporate deductions are available, like organization, startup, and syndication expense. This all we are going to discuss in detail in the latter section. Charitable contribution, dividend receipt deduction, casualty losses, R&D expenses, and insurance premium. These are the special deductions which are available to a corporation. All routine business expenses will be deductible, that's normal. But these are additional expenses which can be deducted by a corporation. Capital loss is deductible only against the capital gain. No deduction of net capital loss in the current year. Net capital loss will be carried back 3 years and carried forward 5 years. So look at this. Net capital loss will be set off against the capital gain only. If there is a net capital loss, it will not be deducted in the current year. It will be carried back and carried forward. Carried back 3 years, carried forward 5 years. So that is the treatment of capital loss, which is slightly different than the individual. If you see about the individual rule, it was different. And in the corporation, it is different for that. So no deduction of capital loss against the other income. It is only set off against the capital gain. Just be very clear. Some special rules. All corporations and a member of control club are taxed at 21% from 2018. That's a flat tax rate given 21%. Passive loss rules. C corporation can, if we talk about the C corporation, then passive loss. Passive loss can set off passive loss against any income. If you have C corporation is large corporation, we can say. Corporation are divided into, but basically C corporation and S corporation. C corporation is a large corporation, S corporation is a small corporation. So if you are a C corporation, then you can set off your passive loss against any income. So it can be set off against any income. If we talk about a closely held corporation, which is like a private company, they can set off the passive loss against the active income, but not against the portfolio income. Active income can be set off against the passive income, but portfolio income cannot be set off. Portfolio income means like interest, dividend, all are considered as a portfolio income. And if we talk about a personal service corporation, wherein the persons involved are into service providing business, so that corporation is called as a personal service corporation. They can set off passive loss only against the passive income and not against the active income or portfolio income. So for the different corporations, the different rules are being applicable, so you need to consider accordingly. What is a closely held corporation? The definition is given. It means a corporation whose more than 50% of stock is owned by less than or equal to 5 individuals at any time during last half of the year. So if more than 50% of stock is owned by 5 or less individuals, then it is considered as a closely held corporation, like a private company. Personal service corporation means a corporation where employees are engaged into a personal service providing and also held a majority of the stock, like a firm of doctors. If the employees are engaged into the service providing, personal service providing, and they are holding the majority of the stock, it is considered a personal service corporation. Now, reconciliation of book income versus taxable income. Reconciliation of book income versus taxable income means we know obviously there are certain differences between the treatment of any of the item in the books and income tax. So there will be a difference, and accordingly there will be a difference in the income as per book and income as per taxation. So we need to reconcile. We need to reconcile the income as per book and income as per tax by the different rules. So what can be the difference? See, certain expenses may be deducted in the income tax but not in the book. Certain expenses may be deductible in the book but not in the income tax. Certain income may be taxable in the income tax but not included in the books. Certain income may be included in the book but not taxable in the income tax. So there are 4 different adjustments which can happen, and accordingly there will be a difference between income as per tax and income as per books. So we need to just reconcile. How the reconciliation will go on, let's see. First, we are talking about Schedule M1. Schedule M1 is a reconciliation of book income to taxable income. Book income to taxable income before DRD and NOL. DRD is a dividend receipt deduction, NOL is a net operating loss that we will discuss in the later section. But this is a reconciliation of book income to taxable income. Just see how it will be calculated. See, we'll write a book income first and then we'll adjust the 4 things. These 4 things will be adjusted and will come to the taxable income. Okay, what will be adjusted? will add, what will add? Non-deductible expenses which are deducted in the books. The expenses which are deducted in the book, but as per income tax, it is non-deductible, it will be added back to the book income. Will add, what will add? Taxable income which are not included in the books. Such income which are taxable in the income tax, but it is not included in the books as per the books rules, so it will be added back. Will reduce, what will reduce? Non-taxable income included in the books. Certain incomes which are included in the books, but it is exempt from the taxability, so it will be reduced. And will reduce deductible expenses which are not deducted in the books. Certain expenses which are not deducted in the books, but it will be allowed in the tax and purpose, so it will be reduced. So these four adjustments will be there. If I just say you in short, incomes. See, incomes, if it is included in books, but exempt from the tax, then you need to reduce. If the income is not included in book but taxable as per the tax purpose, so you need to add. Then if I talk about expense or losses included in books but not allowed for tax purpose, then you need to add back. And not included in books but deductible in income tax, so you need to reduce. That's very simple to consider for the purpose of reconciliation. And after giving all these four adjustments, you will get a taxable income. So in the schedule M1, you need to read from book income to taxable income. See, for this calculation, your knowledge about deductibility of expense and taxability of the income is very relevant. So you need to know which expenses are deductible, which income is taxable. That will be very much needed for this calculation. So just be very clear. Okay. Next, we are talking about the reconciliation of retained earning, which is a schedule M2. Retained earning. Retained earning at the beginning of the year and retained earning at the end of the year, we need to reconcile what is added and what is reduced from it. So that is a reconciliation. It is a reconciliation of retained earning at the beginning and end of the year. How to calculate? See, retained earning at the beginning of the year, add net income in the books. Current year net income will be added. Other increases in the retained earning to be added. Less dividend paid, that's appropriation from the retained earning, that will be reduced. And less other decrease in the retained earning, like to transfer some amount from retained earning to other reserves or any other way, then it will be reduced. And finally, you will get the retained earning at the end of that. So it's a reconciliation of the retained earning at the beginning and at the end of the year. Whatever increase or whatever decrease in the retained earning, you need to just add it or deduct it, and finally you will get the closing balance. So opening balance, closing balance will be just matched accordingly. Okay, now if we talk about Schedule 3, Schedule 3 that is divided into three parts. Part 1 provides a certain financial information and reconciles a worldwide net book income to net income included in the tax return. Worldwide book income included in the tax as per income tax. So that's a part number 1. Part number 2 reconciles a book income with the taxable income showing the timing differences and permanent differences. And part 3 reconciles a book expenses with a deductible expense showing about the timing and permanent differences. See, part 2 and part 3 are similar. Part 2 is talking about income and part 3 is talking about expenses. So incomes bifurcation will be shown in part 2 and expense bifurcation will be shown in part 3. You can see there are two things they are mentioning: timing difference and permanent difference, which I had also explained in the previous sections. Timing difference means the difference which arrives in the one period and reverse in the future period, and permanent difference means the difference which is never going to be reversed. Like if you are getting a more depreciation in the income tax, if you are getting a depreciation above cost in the income tax, that is never going to be reversed in the book, because in the books you are going to get a depreciation only up to the cost of the asset. So as per income tax, if the depreciation is allowed beyond the cost of the asset, that is going to be a permanent difference. It is never going to be reversed. So that you need to consider for the purpose of timing and permanent difference. So this is schedule number 3. So total 3 schedules are there which you need to consider. First is for book income to taxable income. Second is for retained earning, opening and closing balance. And third is for bifurcation of timing and permanent differences. Okay, now if we talk about net operating losses, that is annual, what we say, net operating losses. Annual is a negative taxable income of the previous year. If there is a negative taxable income, it is the annual. Annual is created up to 2017 will have a treatment like this. Carried back, CB means carried back 2 years and carried forward 20 years. So annual up to 2017 as a this treatment, it will be carried back 2 years and carried forward for 20 years. And annual created from 2018, so 2018 or future. If the annual is created in 2018 or the future years, then what will be the treatment? No carried back but carried forward infinitely. can set off only up to 80% of income before annual. Okay. Carried forwards. From 2018 and onwards, there is no carryback provision, there is only carry forward provision, but carry forward is allowed only up to 80% of taxable income. So let's be very clear on it. Annual is a specific to year and set off using the FIFO basis. If you talk about before 2018, there was a carry back and carry forward provision up to 20 years only. So you need to just use a FIFO basis. First in, first out. The first year annual will be set off against income in that order only. Charitable contributions are not allowed in annual. For annual calculation, we do not consider charitable contribution. Just be very clear on it. Remaining taxable loss, net taxable loss is considered as annual for your purpose. But charitable contribution is not allowed. So you need to consider that. So this being the theory of this unit number 2. Now friends, let us see the MCQs of chapter number 2, that is corporate income. Okay. Question number 1. Which of the following should be included in Schedule M1? Okay. Which should be included in Schedule M1? Schedule M1 is a reconciliation of book income to taxable income. So you need to consider the item which is different involved. Okay. Corporate bond interest? No, it is going to be allowed in both. Opening balance of retained earning? It is not a part of income statement. Cash distributed to shareholder? Again, it is not a part of the statement, or it is allowed in both. Premium paid on key personal life insurance. See, it is allowed in the book income, but it is not allowed in taxable income. So it is going to be the difference between two. So it will be included in Schedule M1. Next, Deo Corporation's book income sold at 2,30,000, which included a federal income tax 80,000 and amortization of goodwill 20,000 based on the 20 years amortization period. What should be reported as a tax income in Schedule M1? Okay, now let's see. You can just make it like this. See, there has been a book income of 2,30,000. Federal income tax. So federal income tax is a disallowed expense. It will be added back. Just see in the question. Federal income tax of 80,000 will be added back. Federal income tax 80,000 plus amortization of goodwill. Goodwill amortization has been 20,000, so it will be added back. Why we are adding back? Because they have amortized over a 20 years period, which is not allowed. While amortization of goodwill should be allowed as per 15 years. As we have seen in the rules, 15 years is a period for amortization of goodwill. You need to add back the provision as per 20 years and you need to reduce as per 15 years.
Now, how to calculate amortization as per 15 years? Okay. See, 20,000 as per 20 years. So, 20,000 into 20 coming to 4 lakh. Total value of goodwill will be 4 lakh divided by 15 year. So, as per 15 year amortization should be 26,667. That will be reduced. So, now let us check. 2,30,000 plus 80,000 plus 20,000 minus 26,667. So, it will be 3,03,333. So this is your taxable income. Okay, now let us see in the answer. Yes, A is a correct option. 3,03,333. Next, book income was reported as a 5,30,000. Items included in the items were depreciation 40,000 more than the income tax, interest 25,000 more than the income tax return, fine paid for the breach of Pollution Act 5,000, interest earned on the municipal bond 6,000. What should be the taxable income in Schedule M1? Okay, fine. So let's see. 5,30,000 is your book income. Now, items included depreciation 40,000 more than income tax. 40,000 depreciation is more than income tax, which is included in the books. So it will be disallowed. So that 40,000 of depreciation will be added back. So 40,000 will add back. Interest income 25,000 more than income tax return. Okay, as per income tax, whatever interest income is there, in the book income it is 25,000 more. So we need to reduce it. Let's reduce 25,000. Then fine paid. Now fine paid is a disallowed expense. So we need to add it back. 5,000 of the fine will be added back. And municipal bond interest 6,000 is exempt income. So it will be reduced. So let's reduce it. Final answer is coming to 5,54,000. So B is the correct option. 5,54,000. Next, The provision for doubtful debt and amortization of preliminary expenses, which of the two are allowed in Schedule M1? Which is allowed, friends? See, provision for doubtful debt is not a deductible expense, but amortization of preliminary expense is a deductible expense, which we have seen at the time of individual rules. You remember the same rule is applicable for corporations. So amortization of preliminary expense is a deductible expense, but provision for bad debt is not a deductible expense. So for answer A it is no, and for answer B it is yes. So no and yes, answer is a D option is a correct option. Book income 2 lakh, municipal bond interest 20,000, interest expense 15,000, out of which 5,000 is relating to debt to carry out a municipal bond. Federal income tax expense 50,000. How much of taxable income to be shown in Schedule M1? Let's see. Book income is 2 lakhs. Okay. Municipal bond interest 20,000, which is exempt income. So it will be reduced 20,000. Then interest expense 15,000, out of which 5,000 is to carry on municipal bond. See, 5,000 of interest expense is for the municipal bond. So it is for exempt income, and the interest expense incurred for the earning exempt income will not be allowed. So we'll add back the 5,000 of interest. Federal income tax expense 50,000, it is again not allowed. So it will be added back 50,000. Okay, so final answer is coming 2,35,000. A is a correct option, 2,35,000. Next, current year there was a provision for doubtful debt created for 30,000, while actual bad debt amounted to 18,000. What will be effect in Schedule M1? See, they have created a doubtful debt provision for 30,000 and actual bad debt came to 18,000. Now, as you know, for the income tax rules, what will be allowed is actual bad debt. Provision is not allowed. So 30,000 of provision and out of that actually is 18,000. The remaining difference is going to be added back. So difference will be 12,000. 12,000 of provision will be added back. So effect will be increase in taxable income 12,000. Opening balance of customer service expense reserve was 50,000 and closing balance was 35,000. During the current year, the provision created was 15,000. How much of customer expense will be deducted in the income tax return? Friends, we can also make a ledger for this, so it will be more clear to you. If we make a ledger for this expense provision, see, provision has been created over here. So there is an opening balance of 50,000 we are putting on a credit side, and there is a closing balance of 35,000 which we are putting here. Okay, and now what they are saying, they have created a provision of 15,000 during the current year. So creation of provision entry will be P&L statement to provision. So here P&L provision has been created for 15,000. Okay, so if we just close the account, we'll get an actual expense. So that is 50,000 plus 15,000 less 35,000. So 30,000 difference is going to be actual expense. Actual service expense will be this. See, they are creating a provision for the service expense. So opening balance of provision was 50,000, closing was 35,000, and during their 15,000 provision has been created. So obviously the difference of 30,000 will be actual service expense. So this 30,000 will be allowed for income tax return as an actual service expense. Which of the differences are considered in Schedule M1? Okay, which differences are considered? Timing difference or permanent difference? Both are considered. Temporary, permanent, both differences are considered. Answer is both. There should be difference, that's it. It can be of any type of difference, timing or permanent, doesn't make any difference. It is to be considered. Book income was reported at 1 lakh, which included a federal income tax of 20,000, municipal interest 10,000, and interest expense 2,000 to carry a municipal bond. How much taxable income to be reported in Schedule M1? Okay, what they are saying, book income is 1 lakh. Federal income tax is disallowed expense, so it will be added back. Municipal bond interest is an exempt income, so it will be reduced. And interest expense to carry municipal bond is a disallowed expense, it will be added back. Okay, so final answer is 1,12,000. D is the correct option. Schedule M1 represents a reconciliation of Schedule M1. What is the Schedule M1? It is a reconciliation of retained earning. So C is the correct option. Retained earning at the beginning and at the closing of the year. Annual net operating loss created in 2019 by a C corporation to be, okay, 2019, it is after 2018 or later. You remember, no carry back, only carry forward. So it will be having a carried forward infinitely. That is the option given. Means it's a treatment for 2019, 2018 or later, any of the year the annual is created, it will be just carried forward infinitely. No carry back provision is there. So this answer A is a correct option. So these being MCQs for chapter number 2. Now friends, let us see the next chapter number 3, accounting methods and periods in entity taxation. Okay, first of all we are talking about accounting period. Which accounting period is to be used by which entities? Annual accounting period is a annual period that a taxpayer uses to compute the income in his books. An accounting period is established by filing a first ITR. Look at this. When you are filing a first ITR, then your accounting period is determined. Different type of accounting periods. Which type of accounting periods are there, which we identify in general? Calendar year means a 12-month period ending on 31st December. That is a January to December is considered as a calendar year. Fiscal year, there is a 12-month a year of 12 months ending on other than December. Like let us say April to March or July to June, any of that. But ending other than December is called as a fiscal year. 50 to 53 week year is a period of 12 months ending on the same day of the week. That is for example, anyone you can say same day of the week. Like let us say if I started in a January on let us say Monday, first Monday of January, then my year will end on the next January Monday, first Monday. You need to consider the same day of the week. If I started with the first Monday of January, then my year will end on the next January first Monday. That's date may be anything. It doesn't make any difference. It's the Monday to Monday. That's very simple. Okay. Adoption of a tax year. C Corporation may follow any tax year by filing a first return. When C Corporation files its first return, that becomes its year for all the future years. So any year can be followed by a C Corporation. Personal Service Corporation, calendar year only. Partnership, same year as followed by partners owning more than 50% of profit and capital. That we'll discuss in the later section also when we discuss about partnership. But the year followed by partners becomes a year of partnership. S Corporation, calendar year only. Estate, any tax year, and trust has to follow calendar year only. So these you need to remember the different years to be followed by different entities. C Corporation can follow any year. Personal Service Corporation, calendar year only. Partnership, year followed by partners. S Corporation, calendar year only. Estate, any tax year. And trust can follow calendar year only. Okay, change in the tax year. How the tax year can be changed? Taxpayer may apply to IRS for a change in the tax year if a substantial business purpose test is achieved. Substantial business purpose. For the purpose of substantial business purpose, only the tax year can be changed. So taxpayer has to apply to IRS and IRS will approve the change in the year if it is satisfied. Now when a substantial business purpose will be achieved, if taxpayer receive more than equal to 25% of gross receipt in last 2 months of the selected year for a previous 3 consecutive years. If you are receiving more than equal to 25% of the gross receipt in last 2 months of the selected year, then it can be considered as a substantial business purpose test and you can change the year by applying to the IRS. No approval of IRS is needed if taxpayer has not changed the year in the past 10 years. No permission needed. Short period does not have an annual. Short period, it means when you are changing the year, there will be a short period. There will be a short year. If the short year is not having an annual net operating loss, you do not need a permission of IRS. Annualized taxable income is more than 90% in the short period. If the income is more than 90% in the short period, then no permission is needed. Corporation status is the same in the short period. Status means S Corporation, C Corporation, the status they talk about. Your corporation should be same in the short period. And change of the tax year by a subsidiary to match with the parent company. Subsidiary has to follow the same tax year as followed by parent company. So subsidiary can change the tax year without a permission of IRS. So these all being a situation where you do not need a permission of IRS for the year tax year change. Less than 12 months of the year. If the year is less than 12 months, then how it will be and when it can be. Due to beginning or ending of the taxpayer's existence and change by subsidiary. Okay. If you begin your business, then it will be a less than 12 months, it may be. If you end your business in particular year, it will be less than 12 months. Or if you become a subsidiary of another parent company, then subsidiary has to follow the year, which is less than 12 months. So due to this reason, if the period is less than 12 months, then tax is computed in the normal way. Full exemption and credits are allowed without any pro rata. There is no pro rata, there is no proportionate. Full credit will be allowed, and tax will be calculated in the normal way as if it's a full year. But due to voluntary change in the tax year, if the period is less than 12 months due to voluntary change in the tax year, then what will happen? Taxable income is annualized. That is actual income into 12 months divided by actual months, and tax is calculated on the annualized income is again prorated. That is tax calculated as above into actual month divided by 12. Like let us say the short period is a 6 month only due to voluntary change, and the 6 month income is, let us say for example 60,000. Actual income is 60,000, then it is to be annualized. How it will be annualized? 60,000 into 12 divided by 6, so it will be 1,20,000. Then on this we'll calculate a tax. Let us say 10% is a tax, so 12,000 is going to be tax. Now this tax will also be now prorated. 6 months divided by 12, that is going to be 6,000. This is how the tax will be calculated. So first income is to be annualized, then tax is calculated, then again it is prorated to actual month. Okay, now if I talk about accounting method, which method is to be followed? Following entities follow accrual basis in general. Normally accrual basis is to be followed by the following entities: C corporation, partnership where C corporation is a partner, and tax shelters. Tax shelters means an entity which is used by a taxpayer to minimize taxable income, so reducing tax liability. So these three entities have to follow accrual basis: regular C corporation, such a partnership where C corporation is a partner, and tax shelter entities. They will follow accrual basis only. However, following entities may follow cash basis. Any corporation whose average annual gross receipt is less than equal to 25 million for past 3 years, and once 25 million test is failed, accrual is must for all the future years. If any of the entities average receipt is less than equal to 25 million in past 3 years, then they can follow cash basis. But if 25 million test is failed, then you need to follow accrual for all the years. Farming businesses can follow cash basis. Qualified personal service corporation. Personal service corporation means organization engaged into services like health, law, account, etc. and more than equal to 95% of stock is owned by employees. If this condition is fulfilled, then they are called a qualified personal service corporation, and they have to follow, they can follow cash basis. S corporation who changed to C corporation after 21st December 2017 but on or before 21st December 2019, adjustment due to change in the method is prorated over 6 years. Look at this. S corporation to C corporation. If you are previously S corporation, now you are moving to S corporation, you are changing your status to C corporation. Then if it is between 21st December 2017 to 21st December 2019, then whatever change, whatever adjustments due to this change in method will be prorated over 6 years. Long-term contracts means the contracts involving production projects taking more than a year to complete. Long-term contract means a project which will take more than 1 year to complete, like a construction going on, that is called as a long-term contracts. In general, percentage of completion method is to be followed because the project will go on for more than 1 year. Let's say it is for 3 to 5 years, then it can take 5 years to complete. Now, here you need to recognize the revenue based on the percentage completion. Whatever percentage completion is there, accordingly you need to recognize the revenue. However, completed contract method is allowed if, what is a completed contract method? Completed contract method means the revenue will be recognized only when the full project completes, not in between. In percentage completion method, it is recognized whatever percentage of the work has been completed. But for a completed service contract, the revenue will be recognized only in the last year when the project is fully completed. So when you can follow the completed contract method, if the project is for a construction or improvement of the realty, it will be completed within 2 years, and average annual gross receipt of the taxpayer is less than equal to 25 million. Okay, if all these conditions are fulfilled, then you can follow completed contract method. Otherwise, in general, percentage completion method is to be used. So friends, this being the theory for this chapter number 3, accounting periods and accounting methods. Now friends, let us see the MCQs for chapter number 3. First, the accounting year to be followed by C corporation is decided by, okay, which accounting year C corporation needs to follow, how it will be decided? Remember, it will be decided by filing the first income tax return. So answer is C option, filing the first income tax return. Which year is to be followed by C corporation? C corporation can follow any tax year as we have seen in the theory. So answer is D option, any year. In which of the following situation tax year may be changed only with the permission of IRS? Only with the permission of IRS. We had seen certain situation where IRS permission is not needed, but they are asking where the permission will be needed. Taxpayer has not changed the tax year in last 10 years. Okay, it is a without permission situation. Corporation status is the same in the short period. It is also without permission. Change of the tax year by subsidiary to match with the parent company, no permission needed. Short period as an annual, yes, this will need a permission of IRS, because short period has an annual, then it cannot be done automatically. So you need to take a permission of IRS. You need to remember the situation where permission is not needed. So here they are asking where the permission will be needed. So last is the answer. In which of the following situation income during a short period is annualized for the purpose of taxability? Remember that a period of less than 12 months, then in certain situation it will be annualized, in certain situation it will not be annualized. Okay, short period due to incorporation of a corporation in the year, no need of annualization. Due to liquidation, no need of annualization. Short year due to voluntary change, yes, there will be annualization. If you change the tax year due to voluntary, your wish, then your income will be annualized for the tax purpose, and then again it will be prorated. In which of the following entity may follow case basis of accounting? Who can follow case basis? Regular C corporation? No, they have to follow accrual. Partnership where a C corporation is a partner? No, they have to follow accrual. Tax shelter, they also have to follow accrual. And a partnership whose annual gross receipt is 20 million, which is less than 25 million, yes, so they can follow case basis. Next, in which of the following condition taxpayer can follow completed contract method for revenue recognition? Completed contract method for long-term contracts. What are the conditions to be fulfilled? The project is for a construction or improvement of the entity, yes. It will be completed within 2 years, yes, it is a condition. And average annual gross receipt of a taxpayer is less than 25 million, yes, it is also the condition. So all three conditions have to be fulfilled for the purpose of completed contract method. So answer is D option, all of above. So this being MCQ for chapter number 3. Okay, now friends, let us see the next one, chapter number 4, that is a special corporate deduction. Special corporate deduction, chapter number 4. See, we had seen that certain special deductions are being allowed to a corporation. So what are those deductions? Let us see. First is the organization cost. Organization cost means a cost incurred in relation to preliminary expenses to begin the business, that is incurred before the end of the year business begins. That is a preliminary expenses. We can say organization cost is equal to preliminary expenses. So how it will be deductible? Let's see. Deductible up to 5,000 immediately. Phase out for the expense incurred above 50,000, and the balance deduction amortized over 180 months beginning from the month of the business begins. Okay. Now, if we talk about how it will be deducted, let's see. For example, organization cost has been incurred at 3,000. 3,000 of organization cost has been incurred in June 2019, and business has begun on October 2019. Then for 2019 year, how much of the organization cost will be deductible? Answer is full 3,000, because up to 5,000 it can be deducted in full. Okay, now let us say the expense incurred was 10,000. Then what? Okay, then for 2019, out of 10,000, 5,000 will be deducted immediately, and balance of 5,000 will be amortized over 180 months. Now if you just check it out, 5,000 divided by 180 month, then it is coming to 27.78 per month. Okay, and for 2019, actually this amortization should begin from the month in which business begins. As I told you, business has begun in October 2019. So for 2019, October, November, December, 3 months will be there. So 27.78 into 3, 27.78 into 3 is equal to 83.34. So 83.34 will also be allowed in 2019 itself. So it will be added here. So finally your amortization will be 5,083.34. This will be deducted in 2019. So what you need to do, you need to deduct 5,000 of the expense in the current year and balance to be amortized over 180 months, and that amortization will begin from the month in which business begins. Okay, now let us say the expense incurred is 52,000. Then what? Then out of 52,000, immediate deduction is 5,000, but this deduction will phase out because your expense incurred is more than 50,000. Acha, how much it is more than 50,000? It is 2,000 beyond 50,000, 52. So 52 minus 58 is 2,000. So in the current year, you will get a 3,000 of immediate deduction, and balance 52 minus 3 is equal to 49,000. 49,000 will be amortized over 180 months. So how it will be? 49,000 divided by 180. So is equal to 272.22 per month. And in the current year, October, if the business has begun in the October, then 3 months over there. So 272.22 into 3 is equal to 816.66. So this will also be allowed. So 3,000 plus 816, 3816.66. This much of expense will be allowed in 2019 and remaining as amortized in the 180 months. So it will go on for the next year, so on. Okay. Now let us say if the expense has been incurred 60,000, then what? Okay. Immediate deduction of 5,000 we get it, but phase out if you have incurred expense beyond 50,000. Beyond 50,000, how much it is? 10,000. So it means it is 0. Nothing will be allowed in the current year. So full 60,000 is going to be amortized over 180 months. So 60,000 divided by 180 months is equal to 333.33 per month. And 3 months in the current year to be considered. So into 3 is equal to 1,000. 1,000 of expense will be allowed in 2019 and remaining will be amortized over the next years. So friends, you need to consider this expense or deduction for the purpose calculation. You need to remember up to 5,000 deductible in the current year, but if the expense incurred is beyond 15,000, then that will be reduced for the purpose of this. It means phase out rule is applicable. Okay, so these is the rule for organization expenses. Next is the startup cost. What is a startup cost? It means such a cost which is regular operating cost but incurred before the business begins. Regular cost but incurred before business begins, like a salary of a cook before starting a restaurant business. Let's say you want to start a restaurant business and you hired a cook, but still the restaurant work is in progress. So you are going to pay the salary to the cook without any activity because the business has not begun. So that salary paid before beginning of the business is considered as a startup cost. Simply you can remember it is a revenue expense incurred before beginning of the business. So it is considered as a startup cost and it is deductible in the same manner as organization cost. So whatever rule we seen for the organization cost, the same rule is applicable for the startup cost. So just be very clear on it. Syndication expense. It means the expense in relation to issuing stock. For issue of stock, for issue of shares, whatever expense you incurred, it is called as a syndication cost, like underwriting commission or premium paid or discount, whatever you say, that is called as a share issue. Legal expenses, it's all are a share issue cost. It is to be capitalized but not to be amortized. Look at this. Share issue expense, that is a syndication expense, will not be amortized, it will be capitalized only. Startup cost and organization cost is to be amortized, but syndication cost will not be amortized, it will be capitalized. Now charitable contribution. Rules are same as an individual. As we seen in the individual rules, the charitable contribution is deductible, but here there are certain changes. Subject to, for a corporation, what change will be applicable? Deduction limited to 10% of taxable income before special deduction of a charitable contribution and annual carryover. Okay, so deduction is limited to 10% of taxable income. Look at this. Excess contribution will be carried forward for 5 years for the purpose of deductibility in the next years. Deduction allowed on an accrual basis if paid within 3.5 months from the end of the year and 2.5 months for a corporation ending on year ending on 30 June. Okay. Accrual basis deduction is allowed for a charitable contribution if you complete your contribution within 3.5 months from the end of the year. Let us say your year ends on December, so you can get a deduction on the basis of accrual. on the December only, but it is to be paid within 3.5 months on the next year. So 3.5 months, it means up to 15th April. Up to 15th April, if you pay it out, then it will be deducted in the December only. And if you are following a year ending on 30 June, then it will be 2.5 months only instead of 3.5. Special rule for a contribution of inventory or a depreciable or a real property. It must be used for the purpose of care of a ill, needy infant or research, etc. Deduction is a lower of adjusted base of property into 2 or adjusted base of the property plus 50% of FMV above adjusted basis. You will calculate these two and lower of it will be your deduction, charitable contribution deduction. This is deductible up to 15% of taxable income instead of 10%. That is a special rule given for it. Normally the 10% limitation is there, but here it is 15%. Okay. Now there is a next deduction called the dividend received deduction, DRD, dividend received deduction. What is a dividend received deduction? Applicable only if the stock of a domestic corporation held for more than 45 days window for equity and more than 90 days for preference. Okay, if you are receiving a dividend from a corporation which is a domestic corporation and your holding period is more than 45 days if it is equity, more than 90 days if it is preference. Also available for a stock of a foreign corporation if stock is held more than 10% of voting stock. If you held more than 10% of voting stock, then dividend received from foreign corporation will also qualify for DRD. Not available to S corporation, personal service corporation and PHC, means DRD is not allowed to S corporation, PS corporation and PHC. PHC is a personal holding company. We'll learn it in the later section. Okay, what is a DRD percentage? See, actually DRD is nothing but a straight away you are getting a deduction of dividend received. You are receiving a dividend and some percentage will be allowed as a deduction. DRD percentage is a 50% if ownership is less than 20%, 65% if ownership is more than 20% but less than 80%, and DRD is 100% if ownership is more than equal to 80%. So depending on the ownership percentage, DRD will be allowed. If nothing is specified, then assume less than 20% ownership, so 50% DRD. Means if ownership percentage is not specified, then you need to assume that ownership will be less than 20%. So accordingly, 50% DRD will be allowed. Steps for calculation of DRD. How to be calculated? Dividend received into deduction percentage, taxable income less deduction percentage, taxable income less step A. And if answer is negative, then DRD is equal to step A. If answer is positive, then DRD is equal to A or B, whichever is lower. The steps are given, but simple I can say dividend or taxable income, whichever is lower into deduction percentage. That is a simple formula you can apply. Dividend or taxable income, whichever is lower, into DRD percentage. That will be your dividend received deduction. That you need to consider. DRD is reduced by the portion of investment financed by debt. See, if you have invested by taking a debt, then up to that portion DRD percentage will be reduced. Let us say you have invested and you have received a dividend from somewhere, but that investment is financed by debt up to 20%. Then your DRD percentage will also be reduced by 20%. Let's say your DRD percentage is 50%, then 50% minus 20% is equal to 40%. The 40% will be your DRD. However, maximum reduction is allowed up to interest paid on debt. That is a limit given line over there, that you are reducing DRD percentage, but it will be maximum up to interest paid, not more than that. So friends, you need to consider a dividend received deduction for this calculation in this way. Casualty losses, rules are same as an individual, except floor base of $100 is not applicable for a loss calculation. Remember for individual we had seen the casualty losses wherein we are calculating losses as AB of the asset less insurance proceeds received less $100 is a floor base, but that is not applicable to corporation. For a complete loss of property, loss is equal to adjusted basis, and for a partial loss, it will be lower of decrease in the value of property or adjusted base of the property. See, if the asset is completely lost, then we can say adjusted base is equal to loss. But if it is a partial loss, then we have to compare adjusted basis or decrease in the value of the property, whichever is lower. That will be your loss. Okay, research and development expenditure, expense immediately in the year paid or incurred, or amortized over a period of 60 months, or capitalized and depreciated over 10 years. Depends. You have given option. You have been given option. Either you can expense off immediately, or you can amortize over a period of 60 months, or you can capitalize in the value of asset and you can just depreciate over a 10 years. Insurance premiums. Okay, what is the insurance premium? Deductible if paid on casualty, mediclaim, life of the employees. These are the deductible insurance. Not deductible if corporation is a beneficiary. If corporation is a beneficiary itself, then it is not deductible. Ordering rule for a corporate deduction. What will be the rule order for deduction? Gross income less normal business deductions. Then you get a taxable income for charitable contribution. Then less charitable contribution up to 10% of taxable income. You get a taxable income for DRD. Then you will reduce DRD. That is taxable income before carryback. Then you make a STCL carryback and you get a final taxable income. This rule you need to, this order you need to remember. Means first of all find a normal taxable income, then charitable contribution, then DRD, then STCL carryback, and final taxable income is there. See why we are actually making this part, because for charitable contribution as well as for DRD you need a taxable income. So which taxable income is to be taken here you need to just see. So this order is to be followed for the purpose of calculation of charitable contribution as well as DRD. So this being a theory for chapter number 4, special corporate deduction.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.